For today's presentation, it's going to be a lot of fun. We're going to get into an overview of fundraising on the way to growing your company, and then also some specific tips and tricks that you can use as you are pitching for investors and how to leverage your company data best for this process. What I'd love for everyone to do is open up the chat and add in who you are, what your company is, and where you're joining us from. It's always great to see who's here in the room with us. What we'll do is bring Eugene and Katie up for the first 30 minutes. They're going to have a presentation they're going to walk through. And then what we will do is open up for questions at the end. So if you do have questions throughout the presentation, feel free to drop those in the chat so you don't have to keep track of those anywhere else. And then I will ask all those questions to our presenters at the end. So with that, I'd love to invite Eugene and Katie up to the stage and have you introduce yourselves.
Awesome. Thank you so much, Jordan. And good morning, everyone in the food bevy community. We're so excited to be here with you today. Thank you for joining kind of lunchtime on the East Coast or morning on the West. As Jordan mentioned, Eugene and I are both from Pilot. My name is Katie Myrick. I'm GM of New Verticals at Pilot.
Sorry.
And today we are going to be focusing on how to approach the fundraising process. Everything from what to consider in terms of timing, what you need to have at various stages of investment, and what investors look for. And we'll also share a lot of highlights from Eugene's fundraising journeys. She's our head of CFO services at Pilot and has been kind of on both sides of the table. She's a former investor at Andreessen Horowitz, and then was a senior operator at Wish, which is a multi-billion-dollar e-commerce platform. And then after that, as Jordan mentioned, we'll open up to questions, so feel free to put them in the chat and we'll make sure to reserve them. So to do intros in a bit more detail, I'm Katie Myrick. I lead growth in New Verticals at Pilot. And at Pilot, what we really focus on is supporting companies with all of your financial back office needs. So everything from bookkeeping, corporate income taxes, budgeting, KPI management, board materials, of course, fundraising and the like. I myself come from a food and bev operating background as well. I'm the former COO of Boba Guys and Tea People. Those of you in California or New York might be familiar. And before that, spent about a decade in the consumer world. So very intimately familiar with kind of the scaling challenges of a very retail-driven physical product business. And what I do at Pilot is support all of our consumer businesses across their various stage of growth. So we work with founders and companies all the way from early stage, pre-seed, pre-go-to-market, all the way to later stages of investment where you kind of blossomed into a much larger operation. I'm super excited to be here with Eugene. As I mentioned, she leads our CFO services team. And together we'll be discussing kind of successful paths to raising venture capital. So I'll let her introduce herself and tell you a little bit more about Pilot as well.
Thanks, Katie. I'm excited to be here and speaking with you today as well. As Katie mentioned, I head up Pilot's CFO services team, which is composed of former founders, finance execs, and VCs. And collectively in the past year, we've grown hundreds of businesses and raised over $1 billion in capital. Before Pilot, I led strategic finance at a large e-commerce company called Wish, where I raised over $300 million of capital there and built the company's financial model in preparation for their fundraisers and IPOs. More importantly, I also defined the KPIs for their new e-commerce initiatives, such as Wish-owned inventory CPG projects, logistics ROIs, and ad spend and marketing return on advertising spend experiments. In Pilot, we specialize in bookkeeping, tax preparation, and CFO services for startups and small businesses like yourselves. When you work with Pilot, you're paired with your dedicated finance expert, your trusted partner who takes the work off your plate so you can focus on your business. Today, Pilot is valued at $1.2 billion after our most recent Series C, led by Sequoia, Bezos, Expedition, and Will Rock. So we're super excited to share learnings from that with you today.
Yeah, awesome. So now that you all know a little bit more about us, we'd love to talk about kind of some of the earliest questions that we get from the companies we work with when it comes to fundraising. And often the very foundational one is, how do you decide if you even want to go for equity fundraising or not? So Eugene, I'd love your thoughts on that.
Yeah, that's actually a very good question. There are a few elements that make you ready for VC. A, is the market super large? And B, you want to grow fast at the expense though of trading away ownership in your company. For context, at Pilot, we were tackling an enormous opportunity, and it made sense to raise money from VCs to tackle the opportunity more aggressively. We see SMB accounting and bookkeeping at about 60 billion in the United States, so that was something that required VC to get us the momentum that we needed. And that's ultimately the question I'd ask. Does your business require venture capital to grow at the rate you'd like to grow? If it doesn't, honestly, that's a good thing. I view fundraising as a necessary evil, not as an accomplishment.
Yeah, I think that's such a refreshing perspective, especially for folks that follow venture capital in general. Often, valuations and how much money you raise can kind of become the important metric in the room rather than what the company itself has actually accomplished in terms of revenue or margin. So it's always, I think, good to remember that the ultimate goal of the company is not to raise capital, but to build the venture. So it seems like a pretty simple formula, large market, which in food is almost always true, not universally, but generally tends to be very, very large markets. And then the second piece is around like, do you want to grow very fast, and are you willing to give up some of that ownership and control in exchange? What are other questions that you'd ask to kind of determine whether the business needs venture capital in particular? Obviously, there's lots of other forms of capital that one could seek in order to really fund the business.
Yeah, absolutely. The most important question in my mind is, what kind of company do you want to build? Venture capital comes with steep growth expectations. I think sometimes when we look at headlines in the news, it seems almost like a vanity metric, like, hey, I raised this amount in capital, or this is my valuation. But actually, do you have the ability to execute on growth expectation that comes with venture capital? Well, you need to be ready to sign up for that if that's the route that you want to take. If you're looking to build more slowly, or your aspirations are to have a lifestyle business, or potentially your total addressable market simply isn't that large, this probably isn't the best avenue for you. There are instances where it is, and it's mindful to know that VC comes with lots of equity and control. There will be more stakeholders with a say in how you run your company. They can be a terrific source of advice, experience, and mentorship, or they can steer you in a direction you hadn't planned to. So being clear on what your goals are should help determine the source of capital that you ultimately seek. And the reason I say this is not to like steer folks away from VC. Obviously, VC is a great way to get growth and achieve like the capital that you want based on your goals. But being mindful of that context helps you go in with a much more knowledgeable view of what you're looking to get out of a relationship with a VC.
Yeah, absolutely. And I think especially in CPG, where there are many other forms of kind of shorter term capital to raise, this is such an important thing to be very clear about, with yourself, with your co-founding teams. So when Pilot decided to pursue the venture path, we raised an initial seed round from folks in the co-founders network, which is always an excellent path if it's available to you. But I think it would be great to hear from you, Eugene, about kind of the process of the seed and the Series A in terms of when is a good time to think about subsequent rounds. I know it can seem a little cart before the horse to start thinking about future rounds when you're possibly, really early stage and haven't raised any capital yet. But it actually ends up being a pretty important thing to sort of think several steps ahead about.
Sure. Happy to chat about that. I think initially, before you actually go to speak to investors, you absolutely want to have at least 6 months of runway when you start fundraising. And of course, the more runway you have, the easier your time will be because you're flexible. So if you can do it with 9 or even 12 months of runway left, even better. A metaphor that I like to tell people is when you apply for a loan with a bank, for example, you're more likely to get better terms if you have good like financial profile, or if you don't need the cash as badly as someone that's applying for a loan from a bank and need it immediately. And the terms will be worse in that case. So this is a very similar mindset to have when you're raising venture capital. The more cushion you have, the more leverage you have in order to raise it at the terms that you want. Basically, if your investors know that you're desperate because you're about to run out of money, you won't have any leverage in the conversation. And unfortunately, fundraising always, I guarantee, takes longer than you think, which is why we recommend having this buffer. It's also important to be thoughtful about how much to raise. When you raise money, you are doing so to get to one or two endpoints. One, profitability. So you never have to raise money again. Two, getting your metrics to a point where you can then raise your next round, which is to your point, Katie. How do you think about what you need to get to the next round as well? So for example, if you're raising your seed round, the question you should be asking yourself is, what metrics do I need to raise a healthy Series A? And it seems like so far ahead to be thinking of what you need to raise your Series A, but it really helps to ground you in like why you're raising this capital today and what this capital will help you achieve in the future. So some questions that investors tend to ask that I've seen is, how long will it take you to get to your next milestone? What resources will you need to do that in terms of personnel? Maybe you need money to get to a specific partnership, et cetera, et cetera. And then you should multiply that number by 1.5x. That gives you a healthy cushion, and that's ideally how much you should be raising in your seed round. I'll also mention a bit about structuring your round size and the terms for the round. I know folks are tempted to optimize for valuation, and investors sometimes ask as well what valuations founders are looking for. And I've seen and heard cases where founders aren't sure, should I be answering this question? Should I not be answering this question? And my advice here is I would not give this information to an investor. Instead, I would optimize for the future rounds. You don't want to scare off an investor or undersell yourself. You can always make a round bigger by letting folks know that there was so much interest, you've decided to increase this round, but you shouldn't create fake pressure or tension to manage the process. It's fairly easy for investors to suss that out. So lastly, I would say take the money when it's offered to you. If you have friends and family or network of connections who are angels, take the money, structure enough of a round to get you back to work, which is your primary focus. You don't want to spend all of your time as a founder fundraising. Instead, it should be in growing your business.
Yeah, that's such a great point, especially for kind of the earliest stages when founders are often wearing so many hats, and fundraising is just one of them. It can feel like a major distraction from actually running the business, even though obviously it's totally foundational to being able to continue to do that. I think something you just said on the angel side is maybe a tangent kind of worth going into, because I feel like there's a lot of different opinions about that out in the market. Do you think angel investors are worth the trouble, so to speak? I feel like sometimes you hear that like conventional wisdom is that if you have too many angel investors, you kind of clutter up the cap table. It's a lot of administrative headache for you to manage. Do you agree with that, or what are your thoughts on kind of going the angel route?
Yeah, the angel route is a lot more popular today, and I actually have a bit of a contrarian view on this, in terms of like cluttering the table and having administrative headache. I would say for a certain type of angel, go big and collect as many checks as you can. For what I mean by a certain type of angel, generally there are three types that you'll see in your circle. One, malicious, Rarely you'll see intentional bad behavior. More often, you'll just generally see slowness on their part. And you can actually tell by talking to other founders because it's a small community. Folks know how angels like behave amongst one another. Um, Too neutral, and this is the vast majority of angels that you will come across. Essentially, they send you money and you never hear from them again. This isn't a bad thing. You're funding the business, they're low hassle, they don't take up your time. And if you ask them for a favor once a year, you have a 50% chance of it happening. All things considered, that's really good. Someone's sending you money, kind of hassle free. You go ahead and do your business, and it's a great place to be in. I think the third type of angel, which is on everyone's wish list, is a transformative angel. And this is extremely rare, but sometimes you happen upon someone whose impact is transformational in the way you run your company, maybe from their past experience or from network of folks that they know that they can introduce to you. They will be your trusted thought partners who help you navigate sticky situations. They'll also serve as sounding board for tricky decisions, and they'll be advocates to introduce you to top tier investors. A pretty great set of like pros that you get from this angel. So they are definitely worth their weight in preferred shares. Here's the problem though, it's kind of impossible to tell who is going to be transformational upfront. And it's not actually about the angels themselves, but kind of the intersection of the angel's expertise to your specific company. So even if they were transformational, for example, to Katie, it's no guarantee that they will be transformational to me. It really depends on the fit. So if you're reasonably confident you can filter out malicious folks, the only way to increase your probability of landing transformational ones is simply let more people into your table. If most of them are neutral, that's not a bad thing. As I mentioned, they're giving you cash, hassle free, you never hear from them again. Probability dictates that you're virtually guaranteed to miss out on the transformational ones if you don't let more angels into your table.
Yeah, I love that. I think it really does come down to, are you able to kind of filter out the folks that maybe will have bad behavior? And to your point, I think they're kind of few and far between. It's more just about slowness and leveraging this network communities like Food Bevy, where you have a chance to really interact with other founders going through a similar process. Those reputations tend to come out pretty quickly. So that makes a ton of sense to me. Awesome. One thing I'm really curious about, especially as folks start to get deeper into the process, it can feel like even just within the umbrella of fundraising, there's so many moving parts to think about, to produce and to polish. Like even as I look at this slide, it's like, wow, there's a lot of things I need to think about. If I kind of break it down to two pieces, like the pitch, the story, versus the underlying financial model and like the true unit economics of the business. Where do you see most companies kind of run into roadblocks? Do folks have more of a tough time with the storytelling or kind of the under the hood financials and getting those super airtight? Like where would you spend most of your time or recommend that founders spend most of their time?
Yeah, I think both are important. In an early stage, ultimately, it's the story that sticks. So you have the storytelling side, you have the financial side. I would invest heavily in the pitch, meaning the story, both on your written deck and your delivery of the deck. To get ready for your first reach out to investors, there are some key elements of storytelling to get dialed in. My advice it would be to read and research your VC options. So you're only reaching out to folks who are looking for investments for your type of business. And the reason for that is you can then tailor your pitch to the partner you're pitching to by making sure that your product is in the right market and is in the right stage for them. so many investors put information on their website. So you can actually use their website as kind of like a gut check. Is this the right investor for me? Will they invest in me? So it's important to do your homework there. The websites are a good place to start. Off slides, I think it's really about appealing to your founder market fit for your business. Investors want you to be the founder who are working on a problem that they're passionate about, and they're really testing your resilience for when the journey gets tough, which I'm sure most folks in this room know that the journey will get tough. And founders want to know that the people that they're backing will be the ones to wave the storm and can stand by to grow the business. All of that said, the later the stage of funding, the more important the financial sides are. So, what are your concrete results? What are the metrics that you have on hand? And investors will expect to see more rigor in everything under the hood. So, both of these should happen in parallel, and an early stage storytelling should be the one to get dialed in as quickly as possible. Historicals should be airtight by the time you're later stage, clear management commentary on performance. These are some things that we help with under CFO services, where we help to explain your key levers to make sure that you can then talk about assumptions in any of your forward-looking models in the due diligence process.
Yeah, I think the part of the good news, right, is that founders tend to be very passionate for obvious reasons about their product, about their company, their aspirations, and they're very close to the story. So I think often it's where they, really, really shine. But aside from the storytelling piece, I'm curious, like, what were the other big considerations for like helping someone really stand out? One of the challenges with raising venture capital is that these investors see literally hundreds of companies come across their desk every year. And especially in a space like food where categories can get very crowded very quickly. I think being able to kind of differentiate yourself, both the product, but also the company and the opportunity is so important. I know, you and your team really do a lot of this advising for our pilot customers. So I'm curious, like, what do you see being most effective in like really standing out?
Mhm. Yeah, look, at its very core, fundraising is storytelling. There needs to be a compelling story. Why should this business exist? How staggeringly large will this company be once you succeeded? And what will the world look like post your company? And as mentioned before, it's ultimately about you and about the team as well. So, why are you the team to do it? These are table stakes, and if you don't have this, it's very difficult to raise venture capital. Assuming you do have it, you'll find that potential investors will pretty rapidly identify you for the area they are concerned about with your business. And that's where you want to spend more time in your pitch. Something that I always recommend founders to do is actually test the pitch with their friends and family, their trusted advisors, or getting guidance from an outsourced CFO to see what are questions that they would ask. And you want to prepare for that. In Pilot, for example, it was the questions that got asked a lot was Pilot's gross margin. Can you demonstrate to us that this business is going to have strong gross margins with time? And to tell that story, we went pretty deep into our KPIs and projections that were related to this specific metrics. So once we knew that this is a question that an investor would ask, we prepared super hard to make sure that that's super airtight. It's a story that we can talk about in the forward-looking models. So you want to incorporate this kind of stuff directly into your pitch. What are questions that folks will ask? Let's address them from the get-go. It really shows that you know your stuff. Basically, if you know you're going to get a particular question, nip it in the bud as you talk about your company.
Yeah, that makes sense. Kind of get ahead of it. Yeah, I think on that note, as I think about, my past roles, the two specific metrics that often was important to get ahead on were lifetime value and customer acquisition costs, especially if you're focused really on the e-commerce channel. On the lifetime value side, like you work so hard on acquiring your customers, like, are you able to retain them? Are you able to grow their AOV over time? Are you able to cross-sell them or kind of increase their purchase rate? And then on the other side of the equation, the customer acquisition costs, they they tend to grow over time. So are you able to kind of find scalable channels of acquisition? Has always been kind of a metric that investors push on for companies where e-commerce is a pretty critical part of the model. Maybe let's talk more about this like, what are the key metrics at various stages? I feel like they really do differ depending on kind of where you are in your fundraising process. So would love to hear more about sort of where to really focus to kind of position yourself across the various stages of investment.
Yeah, happy to chat about this. I think going back to my experience at Wish, looking at their fundraising over time, what I've seen is investors actually evaluate different things at different stages of the company. So in the pre-seed or seed round, you don't have a lot to show in terms of traction, and that's understandable. Investors know this. So they can't make an investment decision based on your revenue or something like that. They'll instead look at things like the size of the market, the pedigree of the team, the degree of initial customer interest. In other words, it's about team and vision. So in Series A, it now becomes about product market fit. Have you built the thing that people love? Do the metrics actually indicate that people love it? At Series B, it's about the ability to continue to scale. So Series A, you prove product market fit. Seed stage, you've shown that you are the right team to do it. This is a great market. So Series B is, will you now be the market winner? So the expectation goes up each stage that you are raising funding for, because they'll start asking questions like, how efficient is your sales process? What is your LTV to CAC? What is your organic growth like? Or is it beginning to pop out? And beyond that, much more about classic metrics get layered on. When Wish started raising their last round of fundraising in preparation for the IPO, investors asked about free cash flow, EBITDA margins, liquidity ratios. Basically, people plug a bunch of numbers into a spreadsheet. And these are numbers that you'll see your public competitors show as well in their annual reports. Said another way, people are the foundation to everything, and fundraising is about storytelling. So for pre-seed, where there is no product and no revenue, you're 1 to 2 years away from knowing if the market needs this or not. The question is, do people fit the problem? Does your team fit the problem? For seed stage, likely your product has been developed, you've like tested it out with a bunch of customers. The question becomes, does the product fit the problem? And if there is a problem or product fit, who is the people buying the product and why are they buying? Why do they care? For Series A, customers have more willingness to buy over and over. Investors want to see if this can scale to unlock growth phase and think about the funds that invest here. So the question is, does the product fit the market? And one of the metrics that I've seen in my past roles as an investor as well as an operator is you want to start looking at your customer cohort a lot more, looking at it from like a laser focus point of view, like who are the customers staying on your platform and why, so that you can have that intelligent conversation to grow your business and with investors as well. Beyond A, the questions are around, does the market fit the growth profile? And so when you are raising a round, it's super important to make sure you've done the homework needed to speak to these specific things that investors look for. And this is one of the areas we spend the most time with our customers at Planet. As you can imagine, there are so many questions that investors ask for at different rounds, but you want to get ahead of it. It helps to be able to brainstorm with folks that have seen it end to end, and is able to prepare you for that in the best way possible. To get more specific for CPG brands, I'd love to actually turn it over to you, Katie, since I know you spend more time in the space. Are there any metrics or narratives you think investors in the space look for that's unique to the industry?
Yeah, it's a great question, and I think in general, I think the dynamics are similar, more similar than they are different. Again, especially for brands that focus on e-commerce, since that tends to have some of the similar profiles to kind of other industries that VCs might invest in. But I do think there are a handful of metrics in CPG specifically that kind of every early stage investor is going to ask, especially if you're kind of past the go-to-market phase. I guess there's four to me that really stick out. One, really obvious, but really important, net revenue. This is the proxy for the scale that you've been able to reach. And it's really, really important to think in net terms, again, especially depending on kind of what channels you're really focusing on from a distribution perspective. I know many of you are already familiar with this, but in case you kind of haven't entered this world yet, going from gross to net can take quite a significant haircut between promotions, trade spend, returns, discounts. A lot of that stuff can be, 20% or more, which is a pretty meaningful difference. And most investors or many investors at this stage will value you on multiples of net revenue. So pretty important to have a good idea of that. Related to that, I think net revenue growth in absolute dollar terms can become really important. Again, especially the earlier you are, you haven't reached significant scale yet. So how fast are you able to grow can be a really good heuristic. And it can speak to what Eugene was saying, which is like, how badly do people want this thing that you are selling, even if you're kind of in the early stages of, points of distribution, et cetera. The other two, a really, really big one, gross margin. In my opinion, I think this might be kind of the metric in CPG. A healthy gross margin is just absolutely vital in order for the overall economics of the business to be healthy. What your specific gross margin target is can vary across CPG. Pretty big variation, can range from like the 40s in something like food all the way to like 80% in something like beauty. But if your particular business or product is kind of plodding along at the 20% and your competitor set is at 40%, like they have 20% more to outspend you when it comes to marketing, hiring their sales teams, their trade spend, and that's going to be really, really tough to compete with. So finding levers to get a very healthy and sustainable gross margin is really, really important. I guess it's worth going off on a tangent here too on gross margin, that it can be one of the hardest metrics to measure accurately and consistently. This is another thing we spend a lot of time with our customers on at Pilot. It can be hard to figure out, exactly what goes into it, how to track that really tactically. You need to make sure it's kind of fully burdened with things like freight, tariffs. All of those things can fluctuate over time. And sort of finding scalable systems for managing margin, both from a financial and an operations perspective, software and process, is something we spend quite a bit of time on. And maybe the last metric I'll mention for this kind of early stage is brand. Not a metric and can be kind of hard to put a finger on, but as early as pre-seed, I think investors will really want to understand what is unique about your value proposition. And I think that's especially true in food, where again, categories can get very, very crowded. Trends can really drive product innovation and investment dollars. So being able to showcase that, whether it's through your packaging, which you can really think about as like your brand's billboard, or the engagement that you're getting on your social platforms, like showing that people are resonant with the brand before you have a chance to show that they're resonant with the product, because you're not in that many points of distribution yet, is really, really important. So those are kind of the four I think about for early stage: net revenue growth, gross margin, brand. As you get past kind of the earlier stage and you're in more and more in market, definitely, again, especially if you're distributing not just e-commerce or direct to consumer, points of distribution and velocity, always going to be really critical. Those are basically the two figures that kind of make up your sales number on the wholesale side. I'm sure many of you are already familiar with that. How many doors or points of distribution is your product sold in? And then how well does it actually sell once it's available? Like how quickly does it fly off the shelf? Similarly, things like stockouts start to matter. Again, those of you that are maybe a little bit further along in your journey, you might know kind of the old adage that it's harder to stay on the shelf than to get on the shelf sometimes in the first place. And many brands will penalize you pretty significantly if you're not able to kind of replan on time. So that kind of gives investors an idea of the health of your supply chain and of your operations to be able to continue managing that. So that's kind of on the wholesale piece. And then I guess the few things I'd add on the e-commerce side, Eugene, you already touched on a lot of these, that especially as you get later in your journey, retention and cohort metrics become really important. Repeat purchase rate, what is happening to AOV over time? Are people spending more and more with you? Ability to cross-sell. And again, on the marketing side, customer acquisition costs, they tend to grow over time. And so finding those scalable channels of acquisition is so important. Organic and word of mouth, the further it can carry you, the better, before you get kind of hooked on the drugs that is Facebook, paid search, Instagram advertising. So there's obviously a ton of metrics that folks look for. And again, the more complex your distribution models, the more you need to think about this. But I think those are some of the really, really critical ones. Well, I know we've gone a little bit over actually at what we thought the initial presentation was going to be. So I'd love to kind of open it up and take some questions. We had a handful of them sent to us ahead of time, but if folks in the audience want to share any questions live, whether in the chat or if you just want to unmute yourself, Eugene and I would love to hear them.
Yeah, Katie, Eugene, I just want to say first off, like, amazing. I love walking through all the points that you talked about, especially in terms of what the fundraising process looks like, and then what are the different metrics along the way. So as you mentioned, if anyone has any questions, feel free to type those in the chat now, or unmute yourself, you can jump on. And while we wait for a couple of questions, I actually had one thing, or a couple of things I want to bring up. So, many companies are, well, you mentioned this difference between like the story and the pitch and how important that is. What I found is most founders focus on the passion piece of the story and less so the business side of the story. So can you kind of highlight like what a good business story looks like during the pitch?
Yeah, I can take this one. So firstly, the passion piece is actually super critical, and I'm not surprised to see that founders nail this right out of the bat. Investors want to know that like you love what you're building, or you really want to see the world change from what you're building. So that's like table stakes to show. In terms of the business side of the story, there's a few things that we look at in terms of, if you want to build a sustainable business, what does it take? So ultimately, what does the total addressable market look like? If there's no demand for your business, then it's going to be hard to build a sustainable business. So the TAM piece is super important. The second piece on the business is, can you talk about the unit economics? And you may not have sold something yet, but being thoughtful about that scale, what is each unit going to bring you in terms of revenue? What are the costs, kind of efficiencies over time to build a sustainable business will be super helpful. And aside from the TAM, the unit economics, you want to think about your go-to-market motion. Building a business is only as important as your ability to sell that. So what are your sales channels going to be? Do you have a good idea of where your key customers are congregating so that you can target them most efficiently? These are the three things I've seen investors zoom in on. I'm not sure, Katie, you may have specific thoughts specific to like the F&B or CPG space.
Yeah, I think the one thing I'd add, on the unit economics side is you got to remember, investors have seen a lot of companies out there. And so I think it's important to both tell the story of kind of where we are today and then where we see ourselves going, especially on gross margin, right? Like scale is going to be a huge driver of what you're able to get to. And MOQs in the early days when you don't have a lot of cash on hand can be really difficult to reach. And just remember that like investors understand that and probably add kind of a mental adjustment to your existing gross margin versus where they think it can go as you really meaningfully scale up. But to kind of the umbrella point that I know both Eugene and I made earlier about like really getting ahead of some of these questions, the more you can credibly show that you will be able to get some of those economies of scale, I think the better position you will be in, right? So talking through, agreements you already have with the suppliers that are volume based. So if you reach X, here's what's going to happen to your margin, or showcasing who on your team has a lot of familiarity with the supply chain and the players in the supply chain in this world, can give investors that confidence that you're going to be able to kind of negotiate those agreements that are going to help you on the unit economics front.
Yeah, I love both of those. One thing that I often talk with founders about as well is, there's most companies in this space fail. And so investors want to know not just why you should invest, they should invest in your company, but why they should invest in your company over everyone else, right? So they're hearing pitches all the time. It's not good enough for you to be just like a good company. You have to be better than everyone else. And that takes having at least like one of those key metrics that blows things out the water, right? Is it your velocity that's actually double the category average? It's something that's like, okay, that's a reason for them to invest. You should have something that's key. If you're just like category average across the line, then you don't make a compelling kind of story for investment.
Yeah, Jordan, I think that's so true. Again, I know I feel like a broken record with this, but like, especially in food, these subcategories can get so crowded and they do have a lot of options. These are really competitive spaces. And so having those points of differentiation are really, really important.
Awesome. Mark has a question.
Yeah.
He asked, oh, perfect. Yeah, you spoke of due diligence documents. Can you go over the most important documents you need to have ready when you start fundraising?
Yeah. So in terms of due diligence, there's a few things that are pretty commonly asked that you actually probably already have it in hand. So it's your incorporation documents, your legal team or the state department will have that. They want to know that you're a legit business. And then two, if you have negotiated any partnership contracts, the investors will want to see that it's legitimate. So these are like the legal must-have documentation that you upload. The things that you need to prepare for the due diligence side is your pitch deck and your financial model. So your financial model should at least look forward like 3 to 5 years, and that should show your gross margins over time, your revenue expectation over time, and how you're thinking about growing your revenue. So it's not just numbers on a page, it's really the numbers will kind of back up the story that you're talking about in your pitch deck. Investors will want to see the pitch deck in the due diligence so that they can use it to refer and cross-reference against the financial model. So besides the legal documentation, the pitch deck, and the financial model, you also want to have your historical financials in good place. And that's why for any startups that are starting to get revenue or even before that, one of the first things I tell them to do is get a good bookkeeper. You don't want to hold the due diligence process back because you don't have clean books. That should be something that is already ready. You're getting it on a recurring basis monthly so that when you do get to a point that an investor asks you to open up a data room for due diligence, that's just something that you upload. That's not something that you're rummaging to call someone to put it together for you. So the time is really spent in dialing your storytelling and your pitch.
Awesome. A couple of follow-up questions. How much financial data and do you include in either your pitch deck or how much financial data do you include in your pitch deck for those first conversations?
Mm-hmm. Yeah, for the first few conversations, I would actually keep the financial data on just the financial metrics that matter. You don't want to go into the nitty gritty of your balance sheet or your cash flow statement. Some key things that you'll want to have at hand are the ones that Katie mentioned previously. So what does your AOV look like? What are your retention rates if you have them? And from a financial metric perspective, what's your gross margin? What's your monthly cash burn? Sometimes, actually, on the pre-revenue side, what I've seen to be pretty important, interestingly, is the pre-orders that have come in. So you may not have actually fulfilled the orders yet, or you may not have sold it yet, but it's a good signal for demand for your product. And that is actually something that would be helpful to showcase to an investor because your competitor may not have that. And that shows that once you go into market, you have the ability to see what the demand will be and predict for it.
Awesome. And then at which point do you actually share your like full financial information?
Mm-hmm. Yeah, usually you will have sent the NDA to the investors and open up the data room, in which case you share all of your financial information to the investor. So that's your books and your full financial model, and that should be consistent with what has been presented in the pitch deck. So the reason I say this is sometimes founders fall into the trap of, I can do the financial model later, let's do the pitch deck first. Actually, they both should go hand in hand, and it should be built on top, or it should be built such that they both support one another.
If there's one thing I can add there, it would just be like, don't underestimate the importance of those financials. The story sticks and the passion is really, really important. But as we've mentioned, like I think a few times today, these investors see hundreds of companies come across their desk every year. They have a lot of options. And so, you don't want to make it harder for them to diligence your company by not having, clean books, easy to understand financials, clear builds from things like gross to net. Because again, they can move on quickly, right? Like you can, I think one good analogy is if you've thought about hiring folks for your team, right? How much time do you spend like looking at a resume? It's pretty fast. And so don't make it kind of harder on them by kind of not having those things really, really lined up, because ultimately that will drive a huge part of the investment. The story might drive kind of, do they invest, yes or no? But the financials will definitely drive the negotiating and the terms, and that's going to be really, really important to you. So kind of, having that at the ready is super critical.
Yeah, I love that. And as EJ mentioned, like one thing that I found, I remember when I first started pitching T-Squares, I just kind of laid out our actually I gave them our weekly sales numbers. And because of the food business, right, like customers order in like bundles. And so we might get an order in 1 month, we might not get another order from them in a couple months. So our sales data was like really bumpy. And honestly, that was a detriment because of how we presented it, because the response was like, oh, why did your sales decrease this week over that one? I'm like, well, our Whole Foods buyer was sick. He had the flu, so he couldn't order, right? That was a real example. I was literally explaining like minutia like that. And so what I learned as well is, definitely like use your data, as Eugene mentioned, like as part of your story. And so if you don't want to talk about the rocky ups and downs of your weekly ordering, maybe it's best looking at it at a quarterly view or a monthly view that really shares the story and the growth that's applicable to your business, especially in CPG. And then the other thing I'll share, like I know a lot of investors are looking to like weed out companies early, and they are looking to get as much information as possible, even if they're not serious of investing. And so I try to, at least for like the detailed financial data, to only give it to investors after they sign a term sheet. And at that point, they're serious about investing. And then at that point, they can make the decision to either pull out or not. But otherwise, you'll have a lot of your financial data out there, and they might invest in a competitor using that data if they weren't serious at all. So there's a lot of people just out there looking for information also.
Yeah, that's super fair. The thing you were saying about kind of really fluctuating sales numbers made me think of one of the prior to the webinar, one of the questions we got, which was really around this idea of like seasonal businesses. Like, how do I tell the story if I have huge fluctuations in my sales? And it is something we definitely see from a lot of pilot customers. I think it goes back to a couple things. One, kind of the umbrella theme of what we've mentioned a couple times today. Get ahead of the question. You're gonna get it. You're gonna get it. So don't wait to get it. Talk about it up front. And then think about how you can smooth some of that consumption. Even if you haven't smoothed it today, kind of what the path might look like. And there's definitely ways to do that, right? One is geographical expansion. This is a huge market. The globe is big, and seasons don't happen at the same time everywhere. Another really big one, I think, is channel expansion. So thinking about who might be the customers who kind of buy consistently throughout the year. Hotels, airlines often have different consumption profiles than a grocery store does for the same product. So think about that. Think about opportunities to open up recurring revenue, whether it's something more subscription-based or bundle-based. Again, especially if you have a direct-to-consumer channel, I think that can often help give investors confidence that you'll be able to kind of ride out the leaner times. And then more on the team side versus the go-to-market side, I think demonstrate that you know how to manage cash, right? So demonstrate your ability to do inventory planning. Be aware of what your options are when it comes to things like credit revolvers. We definitely work with businesses at Pilot that in the earlier stages do need to call on things like that in order to kind of smooth out their own operations during kind of the off season, if you will. One great example is a large kind of sporting goods company we work with, now large, has had to deal with this a lot. Their stuff is a summer product. They have to figure out how to be indoors from like April to October, but they got to buy their inventory in December when there's not as much cash in the business. And so now that they're sufficiently large, one of the first things they're thinking about is expansion into Australia for obvious reasons. But it took them time to get there. And we really spent a lot of time working with them on how to manage cash at a very kind of granular level before they had the scale to really be thinking about, something like international expansion, which is obviously a huge step.
I love that. Kind of thinking about that expansion, Carrie had a question. He's with Planet H2O about how do you pitch the need for expensive marketing budget to potential investors? And maybe that goes into a larger question of what is kind of acceptable to pitch to investors or how you're going to spend money and what are they looking for?
Yeah, Eugene, I'd love to hear your thoughts on like the uses of funds question. I definitely have my own opinion, but I'd love to hear kind of the investors' perspective on this.
Yeah, well, that's a good question. I think we have seen cases where folks raise a bunch of money to just throw it to Facebook and Google and may not have gotten that return on investment. And what you are saying as like a large amount of marketing investment may look pretty different in terms of like what large looks like for each company. So one question that I would first ask is, how much do your customers typically spend? And how long do they stay on your platform? Meaning, how often do they buy your product? Because if actually, let's just say you spend like $1,000 per customer, but in the time period of a year, the customer spends like $3,000 on a gross profit perspective on your product. Then actually, if I'm an investor, I would say this marketing spend is not that egregious because that return is showing in itself from an LTV to CAC perspective. But if you're saying, I want to spend $1,000 to acquire this one customer that will only be spending $100 at best on my product, then me as an investor would start questioning like, all right, what is that go-to-market strategy that you're having here? Is this purely a branding exercise, or does it actually show itself in the return on investment over time? So that's me putting on the finance and investor hat on. Katie, would love to hear your thoughts about this.
Yeah, I think definitely being able to show that there will be ROI on those dollars is super important. I think clearly true outside of marketing as well. I think that if you feel like you're really going to spend outsized dollars here, it's worth going into like where they're going to go, because certain dollars will continue working for you and certain ones don't. And I think Eugene had the great example of like, paid search, Facebook ads, Instagram ads. Those you have to consistently pay for. And if anything, they tend to get more expensive over time. If the type of marketing spend you're talking about, for instance, is, hey, my brand is really going to have to stand out on the shelf. So I'm going to spend a bunch of money up front to really get the branding right. I'm going to work with an awesome agency or a really talented designer, or I'm going to invest money in packaging that is going to make us really, really unique on the shelf. I think that stuff can pay dividends over the long run, and you don't have to keep investing in it, or you do your refreshes, much more rarely. I think those can be kind of more quote unquote acceptable, just because again they'll pay dividends. I do think if you feel like the only way to get folks to really buy your product is through expensive paid channels, it's definitely worth going back to the drawing board and doing more of that customer research and trying to understand like what really drives the fact that, as you said, people like your product more. How can you tease that out? How can you turn that into something more organic? Is there ways to do that on free and cheap channels? Affiliate used to be cheap. Now with the rise of the influencer world, maybe less so. But are there ways for you to drive kind of more organic word of mouth? Can you get your customers involved in kind of the social or community aspect of your brands, where that are perhaps, you know, more scalable and more affordable channels? If you feel like, look, I have to spend $100 in Facebook ads for, you know, every $15 water bottle I sell, like that's going to be really challenging. And so you'll have to think about how to manage that from an economic perspective.
Perfect. We just have a couple minutes left. Any last burning questions that anyone has before we all head out for lunch or so on this Friday?
And I had a few people ask me privately. We'll definitely make sure Jordan has the presentation deck. I think the bulk of the discussion is really where the meat was, but we're happy to share the PDF, and I'm sure he can make sure it gets to the right folks.
Yeah. And I'll share out the recording as well.
Awesome.
Well, perfect. Thanks so much for this conversation. It's incredibly helpful. Loving all the thank yous in the chat. Oh, we do have one question from Mark. Let's see. All right, Mark, you can jump up here.
Awesome. I just wanted to share something because it's probably a tip that might help a lot of participants on the marketing front. And it was a consultant that I spoke with. They were talking about how to get into the Southwest of the United States. They shared a lot of data. But they said on the marketing front, you can either put in, usually a good number is 33% marketing spend in your first year, and then try and get it down to 8 to 10%. If you actually do 20%, you're going to be looking at doing a repetitive 20% year over year over year over year. So try and like position it as we do need to do a lot of money upfront for awareness, and then it'll pay dividends in the long term. So that was one of the big tips they shared.
Awesome. Thanks for that, Mark. All right, Eugene and Katie, if you want to just give a quick roundout of how people can get in touch with you if they have any more questions or want to learn more about Pilot.
Yeah, absolutely. Our emails are very simple. Katie@Pilot, you can reach me. I think Eugene's is very, very similar. We're happy to talk about all things fundraising, financials, how to think about really getting started on this journey, or if you're further along and are thinking about scaling, how to really like manage cash and manage the kind of financial side of the business. We're definitely all ears.
Perfect. Thank you so much for joining again. Thanks everyone for listening in. If you have any other questions, feel free to reach out to me as well. And look out for that recording probably tomorrow over the weekend. Other than that, everyone have a great rest of your Friday and a great weekend, and we'll see you back for our next webinar. Thanks so much.
Awesome. Thanks, folks. Take care.
Thank you. Bye.